Last week, I was ready to buy ServiceNow until I found a few red flags I couldn't ignore. AI is a real risk here, and the problem is it's very hard to predict how this will play out. Gross margins are declining, and there is no clear bottom fundamentally or technically. So in this video, I'm gonna break down the key risks that made me stop, and I will tell you exactly what needs to happen before I will buy into the stock. ServiceNow reported earnings and the reaction of the market was down 17% on the day. The earnings was not bad at all, 97 cents EPS adjusted versus 96 cents expected. And from the revenue perspective, 3.77 billion versus 3.74 billion expected by analysts. So beat both on the top and bottom lines. Subscription revenue was up solid 22%. Current remaining performance obligations was up 22.5%. Solid numbers across the board. But here the numbers start looking more interesting. First yellow flag from the earnings is the current remaining performance obligations guidance for the next quarter is 19%. Remaining performance obligations could be considered as the future guidance for the revenue. The revenue is usually following the RPO, so deceleration to 19% is saying that the revenue will continue to decelerate in the future. Second yellow flag, the guidance for subscription gross margin. You can see the full year guidance is 81.5%, 200 basis points decline. The main reason why gross margins are declining is because ServiceNow is transforming their business to usage-based model, and when they are transforming this business model, they need to pay to LLM providers. So you can imagine that ServiceNow business is on top of the LLM. It could be ChatGPT, Gemini, or Claude. So finally, when ServiceNow is calling by API those LLMs, they need to pay for tokens, and this is a real expense for the business. That's why the gross margin is declining. Third yellow flag is renewal rate is declining to 97%. I would not be panicking if you already own the position in ServiceNow, but if this renewal rate will continue to decline to 96, then 95 and 94. So what is the most important here is the trend, and currently the trend is lower, and I will watch very closely if this renewal rate will continue declining further down the road. Now let's talk about the main risks for software as a service businesses and for ServiceNow in particular. The first main risk is a seat-based model. So let's imagine before you had 50 IT specialists, and for these 50 IT specialists, you need to pay 50 seats for ServiceNow, and ServiceNow is collecting yearly subscriptions from your enterprise. But now, after leveraging AI, your IT specialists are becoming much more efficient. So instead of 50, you just need 5. In this case, ServiceNow will lose 45 seats per year, which is of course significant headwind for revenue. Now the ServiceNow's management already has solution for this problem. They did not disclose exactly how much percent of total revenue is usage based, but the management said that more than 50% of new business is now non-seat based. So the model is clearly shifting away from pure seat-based pricing, but investors still don't know how this will impact margins over time. Now the second problem for SaaS-related businesses with the tools like Claude Code and Codex from Anthropic and OpenAI, it's much more simple now to build a software. And ServiceNow is a pure software company. So here is the CEO's response for vibe coding ServiceNow.
The market might think, hey, maybe I can do everything with a language model and build it myself, which is not going to happen. Every CIO and CEO will tell you, ServiceNow, for a fraction of my overall IT spend, does enormous work for me. Why would I rebuild it with a language model and pay 10 times more?
The problem number 3, gross margins are declined. Here on the screen, you can see in June 2024, gross margin for ServiceNow topped at 78.99%. And fast forward to today, gross margin declined to 75%. The main reason for gross margins decline is because the new business model of ServiceNow is using LLM because they are shifting to AI first company. So they need to use LLM under the hood. And because of that, they need to pay the API or for tokens for those LLMs. This is the real expense for the business, and gross margins is declining. And the real questions for investors is where is the bottom for the gross margins? Will it bottom at 70%, 65%, 60%? This is a really hard question to answer. Problem number 4, very large percent of stock-based compensation comparing to the free cash flow for ServiceNow. Here on your screen, you can see in December 2016, the free cash flow was just $31 million and stock-based compensation was $317 million. Fast forward to today, free cash flow grew significantly to $4.58 billion, but stock-based compensation is still a very large percent of the free cash flow. And what management is signaling recently regarding stock-based compensation is that SBC as a percent of revenue is expected to gradually decline over time as the business scales. AI investments may temporarily increase costs, including stock-based compensation. They are saying basically diluting will improve, but not necessarily in a straight line. The revenue growth for ServiceNow is declining. In 2016, they grew north of 40%. Right now, they are growing close to 20%, and current remaining performance obligations guidance is looking at 19%. Now, here's the response from CEO to the bears who thinks that ServiceNow is doing a merge and acquisition for compensate the lack of growth.
We acquired a couple of companies. So let's talk about that. One was MoveWorks, where in 1 quarter, we only had in 1 quarter, we did in 1 quarter what they never did in a whole year before they became part of ServiceNow. So the go-to-market machine knows how to take great innovation and monetize it. Secondly, we took Veza and Armis. Veza just joined us. Armis just joined us on Monday. So the market might have said, are they doing M&A to cover up for any lack of growth in the core? How could that be true when it wasn't even in the number?
The stock is down 60%, and here's the CEO's response to the question, what should change the narrative in SaaS-related sell-off? Where does the pain stop?
You're such an optimistic guy, and I can sort of sense it today. That energy is being hit by the fact that the stock is having the worst pummeling on record. And you've got RBC saying software sentiment is some of the lowest level in memory. What changes, what shifts sentiment, do you think?
Leadership. You know, the most powerful thing a leader can do is change minds. And the best thing that can change people's minds is performance. And that's why I reiterated with great confidence our full year guidance. I'll be in front of 30,000 people in a few minutes, firing them up on the game plan that we have well in order. The M&A that we did will be additive to a great corporation. This is the fastest growing enterprise software company of all time.
Before investing into any stock, I need to run advanced projections to understand which return on investment I can get if I put my money in this particular stock, because there are so many stocks in the market and you have to put your money to work in the best one with minimal risk and maximum reward. So let's do exactly that. We will run advanced projections for ServiceNow to model the return on investment for the next 5 years if we invest into the company today. Starting from the base case, currently ServiceNow is growing 21%, and we will model for the next 5 years deceleration to 16% in 2028 and then 15% for 2029 and 30. For the net income margin, before I was modeling 25, but now looking at the gross margin decline due to the usage-based model of LLM for ServiceNow as AI first company, now I'm not sure they actually can achieve 25% net income margin, and also stock-based compensation is so high. So now I would like to assign 20% net income margin for ServiceNow. And for the PE, when we have a company growing 15% on a top line with net income margin of 20%, I don't think that more than 25 price to earnings is deserved for the company. Like 30, 35 probably will be too high and too optimistic. With this scenario, we can expect 50% upside for the next 5 years on the base case. For the bull case, I do not have significant deceleration for the top line. So I decelerate to 19% and then 19% across the board until 2030. This will be the case if the bears are actually wrong, if ServiceNow has a real moat, if the customers will not churn from ServiceNow, if ServiceNow will be go-to platform for new customers as well. So they will continue growing and they will continue expanding their TAM. For net income margin, I put 25% in a bull case scenario where LLM tokens and API costs are dropping due to the hardware and software innovation, and they can still achieve 25% net income margin. And for PE, I assigned 30 because we have still the company who growing north of 20% with high net income margins, where 30 could be very justified PE for this kind of company. In this case, we have 157% upside or 20% CAGR for the next 5 years. And for the bear case, I have very bearish scenario for the revenue decelerating to 10%, net income margin of just 15%, and price to earnings of 18. In this case, we can expect downside of 32% for the next 5 years. If you found advanced projections valuable for your own investing journey, I will leave the link for InvestKit in the description below. We have fundamentals, valuation, insider transactions, stock screener to find hidden gems, chart builder where you can build any chart you want for any US company, current InvestKit in the beta, and all premium features are available for free. It's very important to run multiple valuation methods before we make any conclusions if the company is expensive or cheap. I love to see what reverse DCF is showing for the company like ServiceNow. And reverse DCF is showing what free cash flow growth is priced into the company. Currently, free cash flow for ServiceNow is $4.6 billion, and implied free cash flow growth is just 7.36%. Now you ask me, is it cheap? Is it expensive? And to understand is it cheap or expensive, we need to look at the revenue projections. And the revenue is projected to grow in the future 22%, 18%, 18%, 16%, 15%, 14%, and so on and so forth until 2033, which means that free cash flow growth of 7.36% is quite conservative, which means that based on reverse DCF, ServiceNow could be undervalued at these prices. Now, before I share my final thoughts and when exactly I'm going to buy into the ServiceNow stock, here's the CEO's take on the very close catalyst in May for ServiceNow's investors.
And we're excited to have our shareholders join us in Nevada, Las Vegas in a couple of weeks to explain the midterm and the long-term plan of ServiceNow, which is to double the company in the next few years. So we're excited. We're ready to go.
Now my final thoughts and when exactly I'm going to buy into ServiceNow. Firstly, I believe ServiceNow is a really strong company, but it has a real AI risk. I believe this sell-off is partially justified. Now, ServiceNow has currently a few yellow flags which does not allow me to buy into the stock, but this is exactly when I'm going to purchase. The first thing I'm going to look for is the bottom in the gross margins and stabilization in growth margins. It will show me that the profitability will not continue declining for the company. Second, I want to make sure the renewal rate does not continue to grow. So I want stabilization at 97%, or in the best case scenario, I won't even come back to 98% renewal rate. And the last catalyst which makes me buy the ServiceNow stock is a technical reason. Now, I'm not technical expert and my technical analysis is very basic. But here, basically what we can see is that both 9 and 21 weeks EMA currently are dropping, and every time the price is touching these EMAs, it's being rejected again and again. Another thing I can see in the chart is that volumes are increasing while the price continues to go down. So what I want to see is the price stabilization, the price is reclaiming 9 and 21 weekly exponential moving averages, and the price at least stabilizing, making the bottom. Thank you so much for watching. If you are a ServiceNow shareholder, please let me know in the comments what did I miss during my research. If you want to use InvestKit to analyze stocks, make advanced projections, use screener and reverse DCF, find the link in the description below. Thank you so much for watching and I will see you in the next one.